Every trader has heard the same line over and over again. Fear and greed are what kill traders. It's in the books, it's in the motivational quotes on social media, it's even in those trading psychology infographics that get passed around like gospel. And on the surface, it makes sense. Fear makes you cut winners too early. Greed makes you chase bad setups. Both lead to mistakes. But here's the problem. Fear and greed are not what destroy most accounts. The real killer is far more subtle. It hides behind your decisions. It feels comforting in the moment. And that's why it's so dangerous. Because unlike fear and greed, which at least announce themselves loudly, this emotion slips under the radar and convinces you that you're doing the right thing, right up until your account is gone. That emotion is hope. Now, before we dive in, let's be clear. Hope in life is good. Hope pushes people to endure hardships, to strive for something better. But hope in trading is lethal. Because the moment you start hoping, you've stopped managing. Everyone who's blown up an account has felt this. The losing trade that starts moving against you. At first, you're calm. It's just noise, you tell yourself. Then it keeps slipping lower. Your stop is getting close. Instead of respecting it, you think it'll bounce. It has to, you hope. And for a while, sometimes it does bounce. That's what makes hope so addictive. You convince yourself that waiting it out was discipline, that holding through the pain was the right call. You reward the wrong behavior, and the next time it happens, you're even more willing to ignore your stop. Until one day the bounce never comes, and the hope that once felt like safety becomes the emotion that wipes you out. This is why hope is the most dangerous emotion in trading. Fear and greed at least make you act. Hope keeps you stuck. Take a fictional trader we'll call Alex. He went long on a stock at $50. His stop was set at $49.50. But when price hit $49.50, he couldn't bring himself to sell. He told himself, it's oversold. It'll come back. Price hit $49. Then $48. By the time he finally bailed, it was at $46. His loss was 6 times larger than it should have been. What killed Alex wasn't fear. It wasn't greed. It was hope. And here's the irony. Hope doesn't just trap beginners. Some of the biggest blowups in history came from hope. Victor Niederhofer, once a legendary hedge fund manager, lost everything because he refused to admit he was wrong. His positions kept bleeding, and instead of cutting, he held on, hoping the market would turn. It didn't. His fund collapsed. The same pattern played out with long-term capital management in the late 1990s. Some of the most brilliant financial minds in the world, Nobel Prize winners, loaded up on trades that went against them. Their models said the odds of losing were microscopic. But when reality hit, they didn't cut. They hoped. The fund imploded, nearly taking the global financial system with it. Hope is dangerous because it disguises itself as patience. It tells you you're being disciplined when really you're just avoiding reality. It feels rational in the moment, but it's actually denial. And it doesn't just show up in losers, hope also infects your winners. Imagine Maya, another fictional trader. She catches a strong breakout. She's up 20% on the trade, but instead of taking profit, she tells herself, it can double from here. She holds. The stock stalls, reverses, and erases her gains. What looked like discipline was really hope. Hope that the trade would give her more than it already had. That's the trap. Fear and greed get all the attention, but it's hope that robs traders of both survival and growth. And this is why we need to talk about it. Because until you can see hope for what it really is, the silent killer of discipline, you'll keep falling for it. In this video, we're going to dive deep into the most dangerous emotion in trading. We'll break down why hope destroys accounts, look at real-world examples of how it's taken down traders from beginners to billion-dollar hedge funds, and talk about how to reframe your mindset so you can recognize it and stop it before it kills your growth. This is the PsyFi Trading Channel, where we explore the hidden side of markets and the mind. If you've ever felt trapped by trades that you hoped would turn around, this one's for you. Sit back, relax, hit subscribe so you don't miss what's next, and let's dive in. To really understand why hope is so destructive, let's walk through some stories. Because when you see how it plays out in both retail traders and billion-dollar funds, you start to realize this isn't just theory, it's a pattern. And it doesn't care how smart you are, how much money you have, or how confident you feel in the moment. Let's start small with a fictional retail trader we'll call Ethan. Ethan opened a $2,000 account, excited to finally put his months of learning into action. His first few trades went well. He felt like he was on the right track. Then came the setup that looked perfect. He went long on a stock at $25 with a stop at $24.50. At first, the trade hovered. No problem. But then, price slipped toward his stop. At $24.55, Ethan felt the panic. He knew he should exit at $24.50. But instead he thought, it'll bounce. It has to. $25 is support. Just a little more room. The price hit $24.50. He hesitated. Instead of taking the small loss, he moved his stop lower, $24.25. Minutes later, it broke $24. At that point, he thought, well, it's already down this much. It'll recover. By the time he finally cut it, the stock was at $23.50. What should have been a controlled $50 loss turned into a $150 loss. Hope tripled the damage. Now imagine this happening not once, but dozens of times. Ethan's account didn't blow up in one trade. It bled slowly, death by 1,000 hopeful cuts. This story might sound familiar, because every trader who's been around for a while has done this exact thing. You hope, you move the stop, you justify, and you always regret it later. But hope doesn't just trap beginners, it's destroyed some of the most famous traders in history. Take Victor Niederhofer. In the 1980s and 90s, he was one of the most respected hedge fund managers alive. He managed money for George Soros. He wrote books. He was celebrated as a genius. But in 1997, during the Asian financial crisis, Niederhofer's positions started bleeding. Instead of cutting, he held on. He convinced himself the market would turn. He hoped. And when it didn't, his fund collapsed. Decades of success wiped out in weeks. The man who once seemed untouchable was undone by the same emotion that kills retail traders every day. Another example, long-term capital management in 1998. This fund was stacked with some of the brightest financial minds on the planet, including 2 Nobel Prize-winning economists. Their models told them their strategy was nearly risk-free. But when markets moved against them, they didn't cut. They doubled down. They hoped. And the bigger the losses got, the more they believed the rebound was inevitable. By the time reality set in, the fund had lost billions. It took a $3.6 billion bailout organized by the Federal Reserve to stop the collapse from triggering a global financial crisis. That wasn't greed. That wasn't fear. That was hope, disguised as brilliance, backed by models fueled by denial. Or look more recently at Archegos Capital in 2021. Bill Hwang turned a small family office into tens of billions through highly leveraged bets. For a while, it looked unstoppable, but when his positions turned, he didn't exit. He hoped, he believed he could hold until they recovered, but the positions were too large, the leverage too insane. Within days, Archegos collapsed. $20 billion vanished. The common thread is clear. Whether it's Ethan with $2,000 or Archegos with $20 billion, hope leads to the same outcome. Refusing to cut when you should, believing the market will turn just because you want it to, and losing far more than you ever needed to. Now let's balance this with another fictional example. Meet Maya. Maya started trading with discipline. She set tight stops, journaled her trades, and respected her risk. But she fell into a different version of the hope trap, hoping for more from her winners. One day, she entered a breakout at $50. Within hours, it ran to $55. She was up 10% on size that mattered. Her plan said, take profit. But instead of selling, she told herself, it can run to $60, maybe even $70. She held. The stock stalled. Then it reversed. She watched her gains shrink. $55, $54, $53. At $51, she thought, it'll bounce. I'll just wait. By the end of the day, it closed at $49. Her winner turned into a loser. Hope doesn't only trap you in losses, it robs you of wins too. And this is why hope is so insidious. Fear screams at you. Greed tempts you. But hope feels safe. It feels rational. It disguises itself as discipline. You think you're being patient. You think you're letting the trade work. But really, you're avoiding reality. That avoidance has destroyed more traders than fear and greed combined. Even at the highest levels, the pattern repeats. Niederhofer, LTCM, Archegos, all brilliant, all wealthy, all undone by hope. because when the losses mounted, they couldn't bring themselves to cut. They told themselves the same lie every retail trader tells. It'll come back. Sometimes it does. That's the cruel part. Sometimes hope actually works. The trade bounces, you recover, and you feel validated. But that's the worst outcome, because now you're conditioning yourself to believe hope is a strategy. And eventually, you'll face the one trade that doesn't bounce. The one trade that keeps bleeding until your account is gone. That's why hope is so much more dangerous than fear or greed. Fear and greed might sting you, but hope trains you to destroy yourself. And once you see that, you can never unsee it. The question is, what do you do about it? How do you stop hope from sneaking into your trading decisions? How do you catch yourself before it turns a small loss into a catastrophic one, or a solid win into a heartbreaking reversal? That's what we'll dive into next. The reason hope is so destructive in trading is because it feels good. That's what makes it different from fear or greed. Fear feels bad, greed feels reckless, but hope feels safe. It feels comforting. It's the blanket you pull over yourself when reality gets too cold. And that's exactly why it ruins so many traders. Think about what's happening when you're in a losing trade. Price is slipping against you. Your stop is coming into view. Your rational brain knows what you should do. Cut the loss, protect the account, live to fight another day. But cutting means admitting you're wrong, and admitting you're wrong hurts. Psychologists call this loss aversion. Humans are wired to feel the pain of losses twice as strongly as the pleasure of gains. So instead of facing that pain, your brain offers you an escape. It whispers, "Don't worry. Just hold a little longer. It'll come back." That whisper is hope. Hope dulls the sting of admitting you were wrong. It lets you avoid the immediate pain by trading it for future risk. And in that moment, it feels like relief. That's why traders keep falling for it. It's not that they don't know better, it's that hope feels better, at least in the short term. Let's go back to Ethan. When his stop at $24.50 was about to hit, he froze. Selling would have meant locking in a loss, facing the sting of being wrong, but by moving his stop lower, he bought himself comfort. He didn't have to admit defeat. He got to hope. For those few minutes, that decision felt good. Of course, the cost came later. The loss ballooned, but by then, the emotion had already done its job. Hope had shielded him from the immediate pain, even as it set him up for greater pain down the line. That's the psychology of denial. Hope is denial dressed up as patience. It's the lie you tell yourself to avoid discomfort. Now add dopamine into the mix, and the trap gets even deeper. Here's how it works. Every time you hold a losing trade and it bounces back, your brain rewards you. Dopamine floods in. You feel smart, validated, even heroic for not cutting too early. And that reinforcement wires into your brain. It tells you, "See? Hope works. Hold next time too." It's classic conditioning, like a rat pushing a lever for food. Most of the time, the lever does nothing. But once in a while, it delivers a reward. And that's enough to keep the rat pressing it forever. That's what hope does to traders. 9 times out of 10, holding through a loss hurts you. But the one time it saves you, that's the hit of dopamine that keeps you coming back. This is why so many traders repeat the same mistake for years. They know they shouldn't hold. They know the rules say cut, but they've been conditioned to believe that hope might save them again. And sometimes it does. That's the cruel part. Sometimes hope actually works. Sometimes the stock does bounce. Sometimes you do get back to even. But that occasional reinforcement is what makes the behavior stick. It's not the consistent losses that trap you. It's the inconsistent wins. This is the same psychology that keeps gamblers glued to slot machines. It's not the losses that addict them. It's the occasional jackpot, the flashing lights, the brief euphoria. That intermittent reinforcement is the most powerful kind of conditioning there is. Trading on hope is no different. You get stopped out once, twice, 3 times, and you feel pain. But then you hold just one loser that turns green again, and suddenly all that pain feels justified. You convince yourself that maybe the market does reward patience. You trick yourself into believing that hope is a strategy. But unlike the casino, where the jackpot at least pays out occasionally, the market's jackpot comes at a deadly cost. Because the one-time hope doesn't work, the one time you hold through a real breakdown instead of noise, it can wipe out months, even years of progress. This is why hope is so much more dangerous than fear or greed. Fear and greed are obvious. You can feel them in your chest. Hope hides. It disguises itself as logic. It tells you you're being disciplined. It frames denial as patience. And your brain eats it up because it feels so much better than the truth. The truth being, you were wrong. And that's another reason hope is lethal. Most traders can't stand being wrong. They tie their identity to their trades. A red P&L doesn't just mean a bad trade, it feels like a personal failure. Cutting the loss means admitting that failure, so they hope instead. They'd rather be wrong later than admit they're wrong now. That's what Victor Niederhofer did in 1997. That's what Long-Term Capital did in 1998. That's what Archegos did in 2021. It wasn't lack of intelligence. It wasn't lack of resources. It was lack of humility. They couldn't admit they were wrong, so they hoped, and hope destroyed them. The irony is that the traders who last the longest are the ones who admit they're wrong the fastest. George Soros didn't build his fortune by being right all the time. He built it by cutting quickly when he was wrong. Linda Raschke didn't stay consistent by hoping losers would bounce. She stayed consistent by following her plan, loss or no loss. That humility is what separates survivors from casualties. So here's the cruel joke of trading psychology. Hope feels like strength, but it's weakness. It feels like discipline, but it's denial. It feels like protection, but it's destruction. And until you see that clearly, you'll keep falling for it. The good news? Once you recognize it, you can reframe it. You can train yourself to see hope not as a friend, but as a red flag. You can condition yourself differently, to see the dopamine hit not in holding, but in cutting quickly and sticking to your rules. That's what we'll talk about next. How to actually catch hope in the act, how to reframe it into discipline, and how to build habits that protect you from it before it costs you everything. Now that we've uncovered why hope feels so good and why it traps traders, the next step is figuring out how to fight it. Because knowing that hope is dangerous isn't enough. You have to build habits and systems that stop it from hijacking your decisions in real time. The first reframe is simple, but powerful. Hope is not strategy. That means the moment you catch yourself thinking, I hope this trade turns around, you've already lost the plot. That sentence is your signal. It's your warning siren. Hope doesn't belong in your trading vocabulary. Plans do, rules do, risk levels do. But hope? That belongs in life, not in markets. Ethan, the fictional trader we talked about earlier, eventually learned to recognize this. Every time he caught himself whispering, "It'll come back," he forced himself to write it down in his journal. After a month, he looked back and realized that sentence appeared dozens of times, and every single time, it ended in a bigger loss than necessary. By putting it on paper, he stripped it of power. He could no longer pretend it was rational. It was just hope, exposed. That's why journaling is the second reframe. It's not glamorous. It doesn't give you dopamine, but it's one of the most effective tools for catching hope before it kills you. When you log not just the numbers, entry, stop, exit, but also your emotions, you start to see patterns. You see that you move stops lower out of hope. You see that you hold winners too long out of hope. You see that the word keeps showing up, hidden behind your justifications. Once you see the pattern, you can't unsee it. And that awareness is what creates change. The third reframe is to separate comfort stops from invalidation stops. Here's what I mean. Most traders place stops where they feel comfortable, not where their idea is actually invalidated. They park them right below the obvious low, right above the obvious high, because that's what feels safe. But those are the exact spots that get hunted. Instead, ask yourself, what would actually prove my idea wrong? Not just uncomfortable, but invalid. If you're long because you think the trend is intact, maybe your stop belongs further below the trend structure, not just under the nearest pivot. If you're shorting a breakout, maybe your stop belongs above the zone that confirms the breakout is real, not just one tick above the high. This approach forces you to stop hoping, because when price hits your invalidation stop, there's no wiggle room left. You're wrong, period. The market proved it. You cut and you move on. Now, yes, wider stops mean bigger potential losses. That's where the fourth reframe comes in. Size down. Traders resist this because they want excitement. They want big wins. But smaller size gives you the flexibility to put your stop where it belongs without risking too much. That way, when the stop hits, it's not catastrophic. It's just the cost of doing business. Sophie, remember her? She blew up because she refused to size down when giving her trades more room. She wanted the same dollar profits no matter what. But discipline isn't about keeping profits consistent. It's about keeping losses survivable. If she had simply cut her size, her hope wouldn't have spiraled into disaster. The fifth reframe is to use risk limits. Daily and weekly loss limits are like guardrails on a mountain road. They don't stop you from driving, but they keep you from flying off the cliff. If you hit your daily max loss, you shut it down. No debate, no hope, no just one more trade. That rule protects you from the spiral that hope creates. Marcus never had those guardrails. He hoped his oversized trades would recover, and when they didn't, he kept doubling down. By the time reality hit, his account was gone. A simple daily stop could have saved him. The sixth reframe is to zoom out. When you stare at a 1-minute chart, every tick feels like life or death. Every wick feels like proof that the market is against you. But zoom out to the hourly or daily, and those same moves look like noise. By keeping perspective, you train your brain to stop overreacting. You see that stop-outs aren't betrayals. They're just part of the bigger structure. And the seventh reframe is detachment. And this is the hardest one. Detachment means treating each trade as just one in a long series, not a referendum on your intelligence. It means respecting your stop without debate. When you set it, you've already made the deal with yourself. If price hits here, I'm wrong. No hoping, no renegotiating, no moving the line. The pros detach. They don't fall in love with trades. They don't tie their identity to outcomes. They execute, log, and move on. That's why they survive. Hope thrives on attachment. It needs you to believe that this trade matters more than it does. Detachment kills that illusion. It reminds you that no single trade matters. Only the series does. Now let's put this into a practical checklist, a way to catch yourself before hope sneaks in. Listen for the word hope. If you hear yourself thinking it, stop and reassess. Journal emotions alongside trades. Log the urge to hold. The temptation to move stops. Review weekly. Place stops at invalidation, not comfort. Define what truly proves you wrong. Size down if stops are wider. Protect capital while giving trades room. Respect daily/weekly loss limits. Guardrails save accounts. Zoom out for perspective. Don't let noise trick you into emotional reactions. Detach from outcomes. One trade is nothing. The series is everything. Follow these steps and hope loses its power over you. Because here's the truth. Hope will always creep in. You can't erase it. You're human. But you can build systems that make it powerless. You can catch it in the act, reframe it, and cut it off before it costs you everything. That's the difference between traders who spiral and traders who survive. It's not that survivors never feel hope. It's that they never let hope dictate their decisions. And once you make that shift, everything changes. Because hope stops being the emotion that destroys you. It becomes the red flag that saves you. By now, the picture is clear. Fear and greed get all the headlines in trading psychology, but they're not the real killers. Hope is. Not because hope feels dangerous, but because it feels safe. It convinces you that holding is patience, that waiting is discipline, that avoiding pain is strength. But in reality, hope is denial, and denial destroys traders at every level, from the beginner with a $2,000 account to the billion-dollar fund with a Nobel Prize team. The bigger picture is that trading is not about being right. It's about managing risk. It's about surviving long enough to let your edge play out. And hope is the emotion that most directly interferes with that. It keeps you from cutting when you should. It makes you hold losers too long and winners not long enough. It traps you in a cycle of denial, dopamine, and regret. But here's the encouraging part. Once you recognize it, you can reframe it. You can start to see hope not as a strategy, but as a signal. A red flag waving in your mind, telling you it's time to cut, time to detach, time to follow the plan. That shift changes everything. Think about Lena. Early in her journey, she fell into the same traps as everyone else. She hoped losers would recover. She hoped winners would double. But through journaling and discipline, she caught herself. She started treating hope as a warning sign instead of a comfort. When she felt it, she cut. When she noticed it, she logged it. And slowly, she trained herself to act against it instead of with it. That didn't make her immune to stop-outs or bad trades, but it made her resilient. It meant her losses stayed small, her winners were protected, and her account survived long enough to grow. Compare that to Marcus, who never made the shift. His hot streaks fed his overconfidence. His losers fed his hope. Every time the market turned against him, he clung on, convinced it would bounce. and sometimes it did, which only reinforced the behavior. But when it didn't, the collapse was catastrophic. He blew up because he never stopped seeing hope as a friend. That contrast is the essence of this lesson. Hope isn't just another trading emotion, it's the silent killer. And if you don't respect that, it will catch you eventually. But if you do respect it, if you learn to reframe it, it becomes one of your greatest teachers. Because every time you feel hope creeping in, you can use it as feedback. You can ask yourself, why am I hoping instead of managing? Did I size too big? Did I place my stop in the wrong place? Did I tie my ego to this trade? Those questions turn hope from destruction into education. They shift you from denial into awareness. And awareness is the foundation of growth. Here's the bottom line. Hope in life is powerful. It fuels endurance, inspires change, keeps people moving through hard times. But in trading, hope is poison. Because trading is not about wishing, it's about managing. It's not about wanting, it's about executing. The market doesn't care about your hope, it only cares about your discipline. If you can strip hope out of your trading decisions, you give yourself a chance to survive the grind, to let compounding do its job, to build something real. Most traders never make that shift. They cling to hope until the account is gone. That's why 90% fail. But you don't have to. You can see hope for what it is. You can build systems that expose it, reframe it, and stop it from sabotaging you. And if you do, you'll join the minority who last. The ones who stop bleeding out from denial. The ones who cut losses fast, protect capital, and scale slowly. The ones who treat trading not like a game, but like a business. Because in the end, trading isn't about avoiding emotions altogether. That's impossible. It's about knowing which emotions to trust and which ones to treat as red flags. Fear can keep you cautious. Greed can push you to pursue opportunity. But hope has no place here. The next time you find yourself holding a loser, whispering, "It'll come back," catch it. The next time you're staring at a winner, refusing to take profit because you hope it doubles, catch it. See it for what it is, and then act. Cut the loser, lock in the win, respect your plan. That's how you trade like a professional. That's how you survive. And survival is the only way to grow. This is the PsyFi Trading Channel, where we uncover the hidden side of markets and the mind. If this message hit home, subscribe so you don't miss the next one. Because once you understand that the most dangerous emotion in trading isn't fear or greed, it's hope, you'll never look at your trades the same way again.